Gold eases as traders await clearer signals on the Fed interest rate path.
British pound drops to weekly lows below 1.3600 as US dollar gathers momentum.
Eurozone private sector credit growth accelerates in July. SACE 40 declines. Amid Fitch rating review, political uncertainty. Australian dollar remains firm on firm RBA interest rate hike prospects.
Euro struggles for direction against British pound despite upbeat German data.
Analysis. After 6 months, the Iran war has reached its endgame, a costly stalemate.
Morning bid, Nvidia vaults over high bar.
Indian shares extend losses for second day.
German DAX climbs on tech strength as inflation fuels rate hike odds.
Good morning.
Japanese yen. Range holds with BOJ hike expectations. BBH.
FTSE 100 drifts lower in cautious trade.
Oil. Hormuz supply recovery eases risk premium. BNY. Kiwi dollar US dollar price. Forecast. Kiwi dips below 0.595 as US dollar strengthens. Silver price forecast. Silver US dollar remains sideways near 68.50. Fed Warsh's speech awaited. US yields tick higher as energy drop pauses amid Fed uncertainty. Gold awaits Warsh's Jackson Hole speech. Australian dollar. RBA hold view caps near-term upside against US dollar. ING.
Yo, 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 yo. Hey there, boo boo.
Wrestling.
All right, I guess it's time to get going. All right, Chopin. Adios, muchacho. Was Chopin a muchacho? All right. All right.
Wrestling.
Okay, I'm just getting my other screen set up here. All right, there we go. Guten Morgen. Welcome to Forex.Today, the YouTube community of almost 22,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis. What analysis? What's the big thing? Are we looking for opportunities? Yeah. But you know what the number one thing is? Protect your assets. So we need to identify the threats as well as the opportunities. The overriding goal of planning our trades in advance. Trading is risky, not appropriate for everyone. Past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Okay, let's run through the numbers. Me. Okay, well below 77.77 on S&P, a little wah. Again, completely normal this time of year. VIX right at 15, huh? All right, that's good. We'll take it. That's a little bit of risk on. Could be NVIDIA. Could be a good day in the NASI. Yeah, that could lead to some risk on. Bitcoin back to 80,000. Lovely. With your smile so worn and your teeth so green. Yeah. Gold. What? I'd like it to be higher than that, but it's all right. It's all right. Oil's back up a little bit. Remember, the word on the street is the hot war is over. Now we got a cold war with Iran. Croatia GDP growth eases to 1.7% in Q2. Wayne, trying to run a webinar here, Wayne. 99 on the buck. That's about the same. Yeah, and yields. Hey, we were at 4.75. Now we're at 4.65-ish. Okay. European markets are a bit shaky. French stock market falls. Yep. Jackson Hole starts today. We don't get the big speech till tomorrow. But they're there. Croatia GDP growth eases to 1.7% in Q2.
Australian dollar. RBA hold view caps near-term upside against US dollar. ING.
Look at that.
Silver
S&P
price
chart.
forecast. Silver US dollar remains sideways near 68.50. Fed Warsh's speech awaited. Kiwi dollar US dollar price. Forecast. Kiwi dips below 0.5950 as US dollar strengthens. US yields tick higher as energy drop pauses amid Fed uncertainty. Oil. Hormuz supply recovery eases risk premium. BNY.
FTSE 100 drifts lower in cautious trade.
Japanese yen. Range holds with BOJ hike expectations. BBH.
Yeah, you know, some of this I'm just thinking, U.S. oil, my oh my WTI, we're at 86, 87, something like that, and it dropped all the way to 80. Hey, do you think the psych level, where are the next commodity opportunities? Yeah, you think the psych level, look at WTI, all the way down, we're getting pretty close to 80, pop! That smells like simple trading to me. Oh yeah, no, it's the deal between Iran and Oman. You're like, yada yada wada wada. People bought it at 80. Sometimes people are just making money. So the psych likely came into play. Hey, traders trade always, right? Yeah, traders trade always. Let's break this down into digestible, sweet morsels. 1.38, pretty decent. 4.0, pretty okay, in particular where we've been in the past. Right? Risk is like a box of chocolates. So this is the box of chocolates. Volatility down, that's good. Gold up, that's good. Whoa, Wayne. If you go back 6 months ago, it said if gold was up, that was bad. Well, I redid the math about, I don't know, a month ago. And I told Aiden, I say, look, I don't want any presupposed assumptions like, grandpa's advice. Buy gold. It's a safe haven. I'm like, you don't know if that's true. And I really need to get rid of this. It's just leftover text. So I said, don't assume this at all. Sometimes it's true, but it's definitely not always true. I said, you know what's always true is the correlation coefficient. So measure gold's move over the last 90 days relative to VIX and junk bonds and that kind of stuff, right? So you know if people are putting money into junk bonds, they're taking risk. It's risk on. If they're pulling money out of junk bonds, it's risk off. So we can measure that and then say, well, how do junk bonds move relative to volatility in the market? And how does gold move relative to the S&P 500 or NASDAQ or Nikkei or the dollar and, all this kind of stuff? Like track all of this and then base good, bad, or ugly by the actual real-time relationship between all those assets. And the way that gold has been moving over the last 90 days is when gold is up, things are good. And in the future, if that changes and it does become a safe haven, our score will automatically adjust without you even losing sleep or batting an eye. You will always know the truth because you're Illuminati. You deserve to know the truth. Yeah. And so that's how we get these scores, and good, bad, and ugly is all based on reality in real time. Yeah. It updates every 3 minutes or something. So anyways, when you look at that, right now, the market is moving positively. And what you want to watch today is the NASDAQ Bitcoin price forecast. BTC extends gains as investors shift to debasement-resistant assets. See, we've been talking about that for days. NASDAQ might be up today because NVIDIA, after the close, reported good numbers. And so, what if NASDAQ has a 2% day? You could just you could throw that hypothesis out there, right? So what if that happens? Fundamentals, correlation, and you say NASDAQ. So if NASDAQ, this one doesn't have the percentage. Ooh, too bad. So sad. Do we have it listed somewhere else? I'll see if I can get that for you. Okay, we just don't know how related they are. That's too bad. But NASDAQ. So what could we say? If NASDAQ is up, we'll just say 1%. If NASDAQ is up 1%, S&P 500 will be up 0.9%. Junk bonds will be up 0.56% if NASDAQ is up 1%. Okay? If NASDAQ is up 1%, okay, NASDAQ, if it's up 1%, VIX will fall or has fallen over the last 90 days by 0.71%. Down. VIX down. Japanese yen. Himino signals hawkish shift. MUF dual. ECB accounts. Another rate hike likely unless inflation outlook improves. Okay, same thing. If NASDAQ is up, dollar will weaken, according to what has happened in the recent past. Okay, if NASDAQ is up, S&P 500 will definitely be up. Dow will have a decent day. Okay. And for whatever reason, the UK stock market's down. I guess they don't have any AI stuff in the UK. And check this out. The put call ratio falls. Why? That favors the call. And that is stock market up. Call means up. Cool, right? You see how this works? Bitcoin is likely to be up. Ethereum is likely to be up. Gold is likely to be up if NASDAQ is up today. So I believe NASDAQ futures are up 1%. And once we get to the cash market open, let's say NASDAQ is up 2%. Okay. S&P 500, if it maintains the correlation, will be up 1.8%. Good to know, right? Yeah. Good to know. Good. We got some news out of Kenyatta. Then we got some claims. And then it gets pretty quiet, right? Yeah. Then we worry about Jackson Hole tomorrow. Japanese CPI is important. Okay. Japanese jobs report important. Okay. Anyways. European confidence, consumer confidence.
Pound or yen price. Forecast, momentum cools as cross holds above key support.
We thought European confidence would be negative 29, but it's only negative 26. Yeah. By the way, good morning. It's really good to see you. Or at least your acronyms. Good to see your acronyms. Dude, look at the acronyms on these guys. Beautiful. Whoa, whoa, did it, did it. Oh, come on, Aiden. How come you didn't fix this? Oh, it's curve and ripple. What? Really? Yeah, that's gonna kill the skew, not the skew, but the whatever you call the vertical version. We gotta, yeah, that makes more sense. See, it's just like, hey, crude oil is up 0.28, but curve is up 24%. You think money's going into crypto? Crypto, Ripple up 13. Dude, shut the back door. Yeah. So I know you're crushing it over there, huh? Yeah. Yeah, Brian, you're a big fan of curve, right? I think that's true. Yep. Converted a billion Shiba Inu into curve. Yeah. Nice. Boo-doo, boo-doo. So do you ever use these things? So what I'm doing here is reading the scatter plot for you because this is a contrarian scenario. And like, for example, we're still bearish on NASI and DAX, but they're up today. We're bearish, but they're up today. Bullish and unexpected. So that could lead to a rip opportunity. And that's what this is pointing out. And it's also looking at everything down here. Nikkei's down 0.2. We think it should be up. FTSE's down 0.12. We think it could be up a little bit, but Nikkei should be up a lot. So, okay, the biggest winner that should be a loser, theoretically, is DAX and then NASDAQ. And then the thing that's down but should be up the most is Nikkei. So it's like, hey, you should look at selling these suckers. You should look at maybe buying this one. Not that it will go up. It's just, hey, based on our longer term macroeconomic score, right? They're out of position. And you're like, Wayne, I don't get statistics. I don't really get this. All right. 3 of these things belong together. 3 of these things are one of the same. But one of these things
Canadian dollar
don't
stays
belong
vulnerable
here.
as
Now
US-Canada
it's
trade
time
war
to play
heats
our
up.
game. It's time to play our game. Yeah, go back to Sesame Street. It's kind of like that. Yeah. Back in the 70s, we called it childcare. Mommy's going to be away for a couple hours. You just sit and watch Sesame Street and play with razor blades, and I'll be back. Yeah, that was good enough. Now you need someone with a master's degree and sit there and watch you watch TV, or actually watch you watch your phone. Yeah, how upset do you think my drawing tool's not working here? How upset do you think Facebook is today? They're like, oh my God, 30 of the 50 states just sued us in court, and we have to pay like 3 days revenue and penalties after raping and pillaging families around the world, making more money than God. And you're like, dude, you're going to have to give up 3 days worth of revenue because you're so bad. You're like, dude, you know, not cool, man. Yeah, 18 billion sounds a lot to a lot of people, but I still think it's kind of like arresting a crack dealer who's selling drugs directly across the street from an elementary school to the elementary school kids, and the police arrest him, take him to jail. He spends 5 hours in jail, and then they let him go. And he's there in the afternoon just in time for the kids to get out of school and buy some more crack before getting on the school bus. You're like, dude, didn't accomplish anything. Yeah, but whatever. Sounds like a shakedown to me. All right, I'm trying to get my drawing pen here. There we go. We saw this when banks collapsed in the great financial crisis, and it had to do with crazy, stupid mortgage lending practices that are
Ripple price
100%
forecast.
based on
XRP
greed.
rebounds as whale inflows rise.
And a lot of it had to do with lying. And banks even trading against their own clients, like bad banking behavior, bad finance. That's not, some people pointed out, like, well, it points out the flaws in capitalism. No, points out to the flaws of regulations and too big to fail. No, make them fail. But anyways, what happened was the U.S. government took a lot of these banks to court and sued them. And in court, the court found the banks were guilty of fraud and misuse of funds and a whole bunch of really bad things. And they're like, yeah, we made $400 billion lying and cheating. $400 billion. Well, you know what? We're going to have to charge you $4 billion as a fine. And I never knew, like, where did the $4 billion fine go? Where does it go? Back to the people that were defrauded? I think it just goes to the government. So it sounds like a shakedown to me. Yeah, you're like, did you give the money back to the people that were ripped off? No. So, the banks are going to do it again if they have the opportunity, right? They get to keep 90% of the money they stole. Can you imagine? Like, you arrest bank robbers. You're like, how much did you steal? $1 million. Well, the penalty is 15 years in jail, right? And $100,000. You can keep the other 900,000. You stole it fair and square. It's the bank's fault. They should get a bigger vault. It's the bank's fault that you robbed them. So, but you got caught, so you have to pay 100,000. Yeah, and it's going to fund the police department. Yeah, it's strange. Anyways, I'll get off that. We are looking for patterns. Okay, a pattern bearish and expected. Oops. Okay, bearish and expected. Let's just do this over. Bearish and expected. So everything down here is perfect. bullish and expected. Everything up here is perfect. Perfect meaning it's quantitatively predictable. In fact, we have quantitatively predicted this. And by prediction, I mean macroeconomic score, which we do weeks in advance. Okay. I moved it up a little bit so you can see it. Score of 1, score of 8. Somewhere in here is a 5, right? Somewhere in here is a 3. Somewhere in here is a 7. So everything, okay, on this side of the line should be up according to our math. That's all. According to our math, it's not future guidance. There's a little bit of seasonality in there that might be future guidance, but it's just macroeconomic logic. If you had a textbook, think of it that way. You're going through school and you're taking a macroeconomics class and it's in a textbook. If you add up X, Y, and Z, Aussie dollar should be up. It's in the textbook. It's like, it's just kind of should be. Doesn't mean it will be. Doesn't mean it'll continue in the future because things change. But add it up, you get a number, right? Our number for Aussie dollar is 2.33, says the math. Math like GDP in Australia versus GDP in the United States. Inflation in Australia versus inflation in the United States. Okay, all that kind of stuff, right? Interest rates in Australia versus interest rates in the United States. And we add all these things up, and we also look at the charts. What is trend? What is momentum? We look at seasonality, all this kind of stuff, right? And we even look at the Australian dollar synthetic index that we create, not the one, I don't even, does anybody even have, is there even an Aussie dollar index? We have a dollar index. Is there an Aussie dollar index? I don't even know. So we create our own. And with the dollar index, you can have a equally weighted or you can have a weighted index depending on who's selling the product, right? Yeah. So we create our own. Great. So we compare Australian dollar to all the other major currencies. We compare the United States dollar to all major currencies, create our own indices, and all of this goes into this number. And look, Aussie dollar should be up. Oh, good. It is. Aussie CAD should be up more because it has a score of 6.14. And it is up. It's just, this is the biggest winner today. Why? Well, right? It is what it is. Cool. And these are the outliers, but this is why it's a contrarian. These scores are not very strong. You know, our conviction is 2 or less on these, but they could be up. And these might be buy the dip opportunities, you see? That's why it's a contrarian. Do. So do you guys actually scroll down on this one? I'm assuming you look at, throughout the day, you look at the scatter plot. But then do you scroll down? Like, again, I'm not sure if you're looking at these, but everything over here is bullish and everything over here is bearish.
Diesel's record $100 warning. The oil shock hiding in plain sight.
Okay. Boo-doo-doo. Do-do-do. So Euro Aussie might be the biggest selling opportunity. It's down today, but our score is negative 4.8. It could be a lot more down. Now think of it. How's Australia doing? Oh, it's doing pretty good right now. What is European consumer confidence?
Hundreds
Negative
killed. More than
29.
1,000 missing in Nepal and China after Himalayan flood.
Boo! Sorry. I freaked out all the Europeans. They just jumped. They're not very confident, these Europeans. Wait, it wasn't negative 29. It was negative 27.3. Sorry. I had to use my brain. Silver up. Sounds good. Could be dip opportunities here. Wheat up, gold up, silver up. Cool. And this is what messes everything up. Ethereum is only up 3.6. Yeah. Brent, watching support at $84.83. Societe Generale. Yeah. By the way, do you guys use the Squawk Box? You see how I'm just going through my business, but I'm always being updated? Irvine says, gold. You're bearish on gold? Yeah, I'm very, very bullish. Oh, right on, JGB. JGB does, yeah. Wall Street poised to open broadly up. Mm-hmm.
Nvidia earnings lift market sentiment ahead of Jackson Hole.
Just for fun, let's look over here. Bank of Canada, no change in September. So in 6 days, the Bank of Canada is going to make an interest rate decision. Right now, the odds are in this market, remember, this is based on people betting money. And the money says everybody agrees the Bank of Canada is not going to raise or lower interest rates. A lot of these bets were made a long time ago. So you're like, dude, is it going to close above 70? And you're like, Wayne, it's like 80. Yeah, well, somebody might have made this this bet 5 months ago, 4 months ago, 3 months ago. Yeah. So we're just approaching it, right? ECB, 14 days away from their interest rate decision. And they're likely to raise. Okay, that's helpful, right? Hey, when's the next ECB interest rate decision? Oh, it's 14 days from now, a couple of weeks. Oh, what are they going to do? Well, the market's betting on a rate hike. Again, you don't have to have an opinion. You just know what the market is doing. What about the next ECB meeting in 63 days? No change. Hike, pause. "71 days from a Bank of England decision in November. 80% chance right now. No change." Okay. So you want to watch over time. What's the likelihood or what's the change? are people going to bet? Remember, they're betting with money. Are they betting on, are more and more people betting on an increase? Well, as we get more and more data, people will have more and more informed bets, right? So right now, more people are betting on no change. That's where the flow of bets. But we're 71 days away. So we'll have a lot more information when we're 30 days away, right? So it's just like, it's a cool way to kind of eyeball these things. Just, right? 56% chance the Fed is going to raise, but it's pushed off until December. Okay. Are they going to raise interest rates this year? Maybe. Right now, when we look at the yield curve, which is hopefully how people are making decisions on these bets, but it's not illegal to be stupid. It's socially unacceptable to not be beautiful and living in an exotic, crazy, beautiful life and have crazy, smart children that are very active. Well, at least on Facebook, right? But this is one way to be informed. What do people think? Now, opinions I don't really care about unless you got money on the line. Right? If you ever had someone said, "Oh, I bet you anything," I'm like, "Really?" They're like, "Yeah, how about your car? I bet you your car." Oh, well, no, I don't want to do that. Oh, well, what the heck? You just told me you'd bet me anything. You won't even bet your car. So anyways, this is a cool way to just kind of see what's going on. And remember, when you click on it, December, a hike. Okay. But only a 36% chance. Like, there's no chance they would raise by 50. I mean, let's just, so one, so you could really argue only a 36% chance of a hike. Okay. So, anyways, fun. It's just fun. Why not? We can do it. So, why not? Boo doo doo, doo doo doo. We still love the Aussie. Look at, buy Aussie. Bitcoin is, I'm assuming, being pulled down because it usually falls in August and September. It's just not happening now. It just points out to, something unusual is happening. Yeah. So we know that. So somebody was saying earlier about being bearish on gold. I've been bullish on gold for a long time. A lot of it had to do with tracking institutional investments into gold. And even when gold was falling, institutional investors were holding their positions. So I'm like, I'm going to hold too. And then when I look at what gold usually does in August, it's usually up in August, 3.62%. Short-term day trade, says Jim. Why would you short gold if you're bullish, even if it's a day trade? I don't really do that. Yeah. If I'm a bull, I let it fall and I buy a dip. So that's just how I've always traded, right? Again, my book, Strategic and Tactical Forex Trading. So I'm a bull, it's falling. Good. Awesome. U.S. initial jobless claims dropped to 203K last week. Okay. Yeah. So if I'm a bull, Irvine, I'm waiting to buy a dip. I just don't know when it bounces and starts to go back up or at what price. That's why I have charts. But without even looking at a chart yet, if gold is down, good, by all means, because I want to buy it. Okay. Neat, right? That's how I roll. Now, this is only looking at the 5-year. Maybe I need to pop it up. The reason I have 5 years is I'm trying to avoid COVID nonsense. And 20 years might be too much. 10 years might have too much COVID. So it is what it is. Hey, life stuff. Okay. And maybe we want gold here. Switch it. So over the last 5 years, 60% of the time it goes up. And on average, 3.62, but it could be as much as 10%. And the downside is negative 2.5. So gold does this. That's not fair. Gold does this in August. When you look at the variance, what you'll find is the variance. Let's do this in a different color. The variance of price over time okay, you have to do all the calculations. We'll put a couple more down here. Let's put in a couple of bad years. All right. So now imagine it's a chart too, and right. All right. From the average over time, you got to do a calculation. How far is this and 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 this. How far is that from the average? And if you did a calculation, let's just put it this way, it's as far from average as 9.8%. The average is 3.62. Now, when you then look at the negative variance and you add, look at this and look at this and look at this and you standardize that, right? The square root of the variance, we will do let's do a darker pink, and we'll do purple. All right. It's more like this, and that number is negative 2.77. Okay, so it's usually up. When it's up, when you average even the negatives with the positives and you average all this stuff up, on average, you make 3.62. But remember, average never happens. The analogy I like to use is I'm a millionaire and I meet a homeless person and I say, cheer up, dude. On average, we're both rich. It doesn't make him feel better. Yeah. So average never happens. It's a human construct. But when it's a good month, so 60% of the time, we could have something that's probably above average. Is this clicking? The statistical analysis? Because some people just get lost on the gobbledygook math and you're like, Wayne, I think I get standard deviation, but what? Yeah. So 60% of the time, it's going to be greater than 3.62. Yeah. And sometimes it's even greater than 10, but it's not likely. But actually, if you go to the next level, so if you look at this distance here, let's do this in black. This to this to this is 61.8. Okay. I think it's actually 62. I like to think of it as Fibonacci. So 61.8 in there. And then if you did 2 standard deviations, and you're going to include this stuff, include the outliers, okay, it bumps it up closer to 95%. Meaning it could go up 14%. We just haven't ever seen it do it. There's a 95% chance it won't do it, right? And then if you did a third standard deviation, you get to like 97% chance that price will stay in that range. But so we're not interested in,
U.S. weekly
that
jobless
unusual
claims
kind of
unexpectedly
math.
decrease.
What we want to see is it usually goes up. That's important. And when it goes up somewhere between 4 and 10%. Just in August. So that's why if you go here and you go like, we go here. So we're getting pretty close to the end of August, right? Gold is up 14%. That's why, right, Irvine, right? You're like, oh, well, I'm confused. I'm a bear on gold. And I'm like, what? Now, maybe you're
Euro
front running
choppy range
September.
trading outlook. Rabobank.
Okay, that's different, isn't it? You're like, yeah, it's up 14%. I'm looking for evidence of it rolling over and dropping. Okay, now you're giving forward guidance. So to do that, we want to look at September. September is an up month. October is an up month. November is an up month. And December is an up month. So Aiden has this going up to $5,000 by the end of the year. I'm a bull, bro. I was a bull on the way down. I was a bull on the way up. I was a bull on the way down. And I was a bull on the way up. Was I surprised gold was coming down? No. The velocity, yeah. But we also were able to measure why it was happening. It kind of made sense. Dollar was strengthening during this period, which makes sense, in particular around war. That also makes sense. Although your grandpa told you to buy gold, I could look at the correlation coefficient and say, well, that's not actually what's happening now. But we were also looking at institutional investors, the guys, the gals that had that were actually holding the gold, not the retail fellas. Okay. We were watching these guys. Long gold. And even most of that time, they were not selling even just on the way down. What we may have been seeing when gold went from 5,200 to 4,000 a lot of what you might have seen, could have been the massive increase in US dollars, demand for US dollars, the strengthening of the US dollar. Retail was likely freaking out, and gold ETFs were likely freaking out because they have to, because the retail folks were freaking out. But we saw the US dollar strength. We knew we were at war, so it made sense. And there was some seasonal, okay. But one of the biggest things that made me, long and strong is the people that I'm following. The positions in gold that I'm following are here. And this stayed stable. And so now it's going back up. And I'm like, yeah, well, it's supposed to. And it triple bottomed at 4,000. We talked about it for about 3.5 weeks. And then we were looking for a breakout to the upside and a higher low, and then a long and strong, right? So then we go back to seasonality and you're like, okay. Okay. Look at this. Gold started falling in February. Really? Then it treaded water. But in this case, gold is quiet during this period, but we had something influencing the war, the strength of the US dollar. So gold wasn't, this is the wrong one, isn't it? Why did I go back to that? There we go. Okay. But, this period, we had a bloodbath in gold. May and June are supposed to peak in April, collapse May and June. Peak in April, collapse May and June. I mean, dude, what the heck? Of course it fell, right? Look at this. We have 20 years of data. It peaks in April, falls in May, falls in June. It peaked in April and it fell all the way to the end of June. And on July 1st, the greatest day of the year, Canada Day, gold went up and is projected to go up all the way to the end of the year. How do we do that? It bottoms out in June. It goes ripper up in July, August, September, October, November, December. The velocity changes, but not the direction. Now, anything in the world can happen to strengthen the gold. Okay. But what actually happened this year? January up. January was up. February up. Okay. It dropped and then it went back up. Good. March, okay, was a bad March. Huh? We had a hot war going on. April should be up. It was. Until the 20th, the third week of April. And then down, 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 down. And magically, it stabilized to the day. So this is why I don't really track price for my strategy. I track price for my tactics. Okay. I'm watching everything by satellites first. I need to see the whole battlefield. Okay. When do you attack? Somewhere near the end of June, you attack. Bulls attack the bears. Cool. Bulls are winning. And they're going to win all the way into the first quarter of next year. Oh, so what does that mean? Well, if you're lucky and you use a stop loss and what normally happens, you can hold the gold all the way to March. And or tactically speaking, you buy dips in gold. So with look at all this data. The only period in which gold is supposed to have a significant down, we actually are supposed to peak in March. You see this? And then it fizzles out in April, and then it's just straight up bearish in May and June. We even have it color coded. 20 years of weekly candle data. Okay, Irvine? So like as Jim is saying, if you meant like, oh, well, gold is down today, so I'm confused. How come we're not selling it? I'm like, selling it? Why the hell would I sell this? I'm begging people to get out of their position and sell it to me. I'm a buyer. I'm an accumulator. I am Groot. Okay. Dude, isn't this fun? I hope you guys love trading and investing at least half as much as I do, because I love this. And I look forward to our time together. Like, this is awesome. I'm excited. I've been doing this every day for 25 years. Isn't that a blessing to wake up and you're like, oh my God, what's going on? Am I buying a dip in gold today? Like, that kind of stuff, right? Yeah. Yeah. And this stuff is important because, I'm also an institutional investor. And I need to be smart. It's almost like a requirement. That's a lot of pressure, isn't it? Every single day, you have to be the smartest person in the room for your institutional clients. Like, they look to you. They're like, dude, we don't know what's going on. Here's a bunch of money. We're expecting you to be the smartest person in this room when it comes to investing this money. So you better be data driven. Okay. Yeah. Luck ain't going to carry it, right? All day, every day for decades. You can't be lucky. In fact, the way I've been teaching, and if you went through some of the speeches 15 years ago, let's say, the conversation was about removing luck from your trading. So let's say you made one trade today and you have no data at all. You're just, okay, it's been up, whatever asset, or it's been down. Like, you're selling gold today because it's been down. You don't even see that the long-term trend is up. So what's the chance if you made one short trade on gold that you're going to make money today? Maybe 50-50. Now, if you happen to sell gold in March or April, I'd say you're 60-40, because it could be an up day and a downtrend, right? But if you make one trade and you don't have an edge, then let's say 50-50. If it's a short-term trend, maybe 60-40, but you just have no idea when that short-term trend is going to end. So 3 days from now, you sell again, but it's an up day and it comes back, and well, you gave back the win from Wednesday, you lose it on Friday, So when you're doing one trade a day, you find out if you're good, you're 50-50. Well, that's a lot of unluckiness, isn't it? And who knows, the time you win is probably just as much luck. So it's just luck. You're flipping the coin every day. Okay. What happens if you do it, flip the coin once? It's 50-50. If you flip it a million times, it's 50-50. Like, it just doesn't change. All right. But instead, if you have quantitative data and you don't make one flip of the coin, because you could just simply get unlucky. You might have the right direction, but the wrong time. Dope. Or you have the right direction, but then news comes out, spikes it, hits your stop loss, takes you out, and then whatever, right? But if you made 10 trades a day and you're data driven, so now you have an edge and you're doing 10 trades a day, you're removing the luck. You might have let's say one or two of those trades, you just might get unlucky. You set up a good trade, you bought it at support, something came out, it dropped, took you out for 50 pips, but the other ones worked. Okay. If you made 100 trades a day and you're data driven as well, it's not unlucky. Like if you made 100 trades in a day and lost all 100, was that bad luck? That's just shitty trading. You were like extraordinarily wrong. And your risk management is pathetic, right? Like you can't get unlucky 100 times in a row. Okay. Unless you just did the same trade. Well, then you have one trade 100 times, right? Yeah. But if you were really, truly doing proper technical analysis in at least something that's reasonably trending on some any level of time frame, you're trading a trend on a 1 hour chart. Okay, if you're buying dips in even a short-term trend, there's no way you're going to lose all your trades unless the sucker is completely reversed. Like selling in an uptrend. That's where it gets dangerous, Irvine. You're selling today, but you ignore the fact that this is going to go up for 9 months straight. Okay. So what you do is you find statistically, and this is what it comes down to. If you trade once a day, that's 20 trades a month. So 240 trades a year. It's not very many. Yeah. Luck is going to wreak havoc on your rewards. And then what does an amateur do? Find out they're not making any money, but 60% of their trades are winners, 40% of their losers. So at the end of the year, they just don't have a lot of pips in the pocket. So they're like, well, I need to make more money from all this work. I work on it every day, but only make one trade a day. So I need to jack up my lot size. Okay. Welcome to bankruptcy. Yeah. And then you get Wayne coming to your refrigerator box that you have behind Starbucks. And then I get to play that joke. Hey, cheer up, bro. On average, we're both rich. Broke house trader. Yeah. And you're like, dude, I hate that joke. I'm like, yeah. So what can you do? Well, can you get yourself to 1,000 trades a year? Yeah, lower your lot size. Don't change a thing on your risk profile. I'm assuming your risk profile is conservative and disciplined, right? Your style, because that's what I teach.
Bay Street may open with slightly positive bias.
Positive reaction to NVIDIA earnings may lead to initial strength on Wall Street. So, 1,000 trades that are 25% smaller per trade. Or how about this? Right? 480 trades. So we'll just say 500 trades a year. Half the lot size. No. Quarter the lot size. Double the stop. So you have let's say you have 75 pip stops, 25% lot size, same amount of risk, double the trades, double the stop. What's the likelihood You buy a dip in an uptrend and it collapses and you lose. Statistically, not likely. You understand that process? It's statistically up. I just went over standard deviation and and mean reversion and the averages, and we just went over it. You're like, it's an uptrend. If I only buy dips, the uptrend is going to give me the edge. I know how to buy at support. I can spot a 5-minute reversal on 1 hour or 4-hour support. So it's up. You have pretty good technical analysis to know where a roll reversal is, where a psych level is, where a daily or weekly or monthly pivot is. Like, you're really good at that. You know where the moving averages are. So now with double the stop and 75% less risk per trade, lot size,
Swedish
but then you
krona,
double the lot,
inflation
right?
risks may
double the
prompt
stop.
tougher Riksbank stance. BNY?
So what happens? It's now statistically, I shouldn't say unlikely, but extraordinarily less likely for you to get a lower low, because you're kick ass at technical analysis and you're betting on the long-term trend with institutional investors and normal capital flows around the world. We call macroeconomics. All of this is in your favor. And now what happens if you have twice as many trades and twice the lot size and 1/4%, or sorry, twice the stop and 1/4, right? What's happening? You're getting in trades that are logical and you've removed the risk, the luck. What's the likelihood something extraordinary happens today and completely reverses the market? That's unlikely. That just doesn't happen. Well, it happens. It's just very, very unlikely. How often in North America have you seen snow in July? I've seen it once in my life. Statistically, very unlikely, but I drove through Utah in a 6-cylinder Honda with the windows down, driving well over 100 miles an hour, with opera blasting so loud your eardrums are going to blow out, and I'm smoking a cigar, and it's snowing in July. Okay, things can happen, right? Right? First month, I held a winning trade for 21 days. Feels like forever, huh? Doug's like a boss. Yeah. The thing is, I'm like 20, 21 years old, 20? No, maybe 21. I had to rent a car. I must have been 21, right? Yeah. Yeah. The cool thing is I drove that weekend. I drove, I think it was about 1,800 miles, attended a party, got some sleep, woke up the next day, and drove 1,800 miles back. Yeah. Oh my God. Have you ever wanted to drive all the way through Nevada, all the way through Utah, and all the way around through Wyoming, and all the way down through Colorado? Yeah. I don't think truck drivers even do that. But yeah, the younger days. So anyways, I'm trying to remove luck. I want you to probably make money. So when people outside of what we do um, ask me what I do for a living, I'm a financial engineer. I mathematically engineer profit. I am not uncertain. So we're trying to get rid of that luck. And so that would be one way. You only bet in trends that you can quantitatively prove, in particular in longer time frames. You're not thinking 3 days in advance. You're thinking 9 months in advance, or 6 months in advance, or 3 months in advance. Quantitatively, you're able to use this data, right? Usually things happen as they usually do. That's why it comes from usual. In fact, you may not know this, but usual comes from the Latin word usual. That means most of the time. Yeah. Synonym, normal. Yeah. Yeah. Which is from the Greek, no, mal. Right? No meaning never, mal meaning bad. No mal. Dude, I could almost pull that one off, huh? That almost sounds logical. Yeah. But anyways, normal. So you're betting on normality, and you have this quantitative idea. So now it's it's trade, it's risk. And if you trade incorrectly with the wrong risk management, you have a lot of luck and bad luck, good luck and bad luck inside your trading statistics. And we need to engineer that out. So if you double your lot size, you're going to have to at least cut your leverage in half, right? Your lot size in half to keep the risk the same. Now, if you go through your trading and you find that your doubled lot size, your stop size, and you still lose most of your trades, yeah, it's not, you're just not, you're a terrible trader. I mean, you still have some problems you need to address. Now, maybe you double your lot size to 12 pips. Yeah, that is a problem. When I say double it, I'm expecting your stop should be somewhere between 66 and 99 pips. And you're like, oh my God. Yeah, well, you're over leveraged. Cut your lot size more. Cut it more. And then you're going to be able to trade more with less risk and less stress. And then as soon as you get those trades to break even, you have 100% available margin again. Well, then get in some more and get in some more. And now you're not afraid because each trade's so tiny. You're like, oh my God, this is so small. Yeah, good. Now you're not afraid. Now you're not sweating bullets. Now your stomach isn't churning every time you pull the trigger. You're like, right? And I do talk about this in my book where you're like, I'll put down this pissy little trade. It's a good trade, right? And I've never recommended you do a mediocre throw down a trade and see what happens strategy. But if every trade you made is amazing, but also tiny, minuscule, they in of itself are almost like kind of worthless. They're so small, like you don't even care. Well, you care. It's just you're like it's no big deal. There's no stress attached to it. You're like, I'm buying a dip in an uptrend, like duh. And it's so tiny, you're like, yep, that looks good. Drop the stop. Oh my God, the stop's a million miles away. I'm fine. And then you see another one. You're like, oh, well, that one is so tiny. I can afford 3 or 4 or 5 more trades today. And then you go around and you've analyzed the top 3 or 4 next best opportunities. How do you do that? Stuff like this. We can go here. You're like, okay, well, I took my gold trade, right? Okay. Right. So now what? Oh, let's go check out Aussie, Swissy, Aussie yen, Aussie CAD. Cool. And you find good setups there, and you wait, and you buy dips at support, and you drop to a 5-minute chart, and then you see the reversal right near the support area that you predefined, and you're like, yeah, that's basically the price. And you trade at pre-market open, so you're like, this is a decent time, that's a decent price, that's a pattern that predicts this down move is now going to go back up in the direction of the long-term trend. So I'll drop a pissy little trade that is so low in risk that you're not sweating bullets at all. You're like, okay, I'll put a micro on this sucker, drop that stop. That's great. Then you go over to the yen, and you got to wait another hour or so, and then that one sets up, and you're like, yeah, I'll put another pissy little trade. Now you got 3 or 4 trades. They're so small, you're not stressed about it. 9, 10, 12, 18 hours later, you come back, you're like, oh, they're all positive. Why? You bet on a bearish reversal in a bullish trend. Cool. Move your stops to break even. That's how you start every morning. Move the stop to -3, move the stop to -3, move the stock. And then you're like, good, new day. Can't wait to see for pullbacks. But with the more frequent trading, better setups, smaller lot sizes, wider stops, you've removed the bad luck. And even and the only way to remove the bad luck is remove the good luck as well. Okay? A lucky trade would be like, you think it's going to go up, and so you put down a standard lot, and boom, and it goes up, and you make $1,000. Yeah, well, what if you lose $1,000? Oh, well, that's 40% of my account. There's better ways to lose money than that. Right? So what we have to do is remove all the luck and engineer your profits. So at FX Bootcamp 15 or 20 years ago, we came up with the term profiteer. Yeah. You engineer it. You're probably going to make money. Otherwise, you wouldn't take the trade. There's a big difference in attitude, and the attitude is super important because it impacts
Iceland inflation climbs to 2-year high.
How you trade, but also how you analyze and what you see. It actually, you see something different with a different mindset. You have to train yourself to have a certain mindset. If there's a car accident and 20 people all see it, they all see something different. One of the most unreliable things you can have in trial, because I did study law in the 90s. It was a minor of mine. So I had an internship at the district attorneys. And, dude, interesting life. But anyways, one of the things we studied in one of my first administration of justice classes is eyewitnesses. And the credibility of eyewitnesses are terrible because we are biased. And you see very little. We talked about this earlier. You see almost nothing through your eyeballs. Okay, we're trained to look forward. That's how the human works. But at some point in our human history, things came from the side that killed us. So we started to see peripheral. But all of this stuff over here is made up. I don't know if you know this. 90% of what you see visually doesn't come through your eyeballs. 90% of what you see comes from your brain making assumptions so that you know where to put your foot when you walk, for example. but your eyeballs are not looking at your feet. Okay. It's assumed, right? So like I'm looking here and I'm reading the text and I see changing prices here and here on my charts, right? But I don't know. I can see the stuff over here. I'm still looking directly forward, or I guess I should look at the camera. Looking at the camera, and I can see everything over here, and I can see everything over there, but I can't see any detail because my mind is making that up. It knows because I've looked over here. Oh, yes, Euro Aussie, negative 1.7%. We're bearish. Conviction of 1. So we're not even that confident in it. When I look back here, I see it, but I can't see the detail because my eyeballs can't see it. It's crazy. My brain is filling it in. It remembers what I saw. Then I look here and all the details go away. If we had true peripheral vision, I should be able to focus here and here. It's totally made up. It's completely fake. So when there's like a car accident, there's 20 witnesses from all over the place. All 20 people see something different because nobody actually saw it. The brain made up the and you saw, even when you were looking at it, you saw almost nothing, and your brain filled in everything else. Cool. So in trading, you have to train yourself to see your bias. That works for you. You can't just randomly have your mind make up 90% of everything you're looking at, right? And then what do? We respond emotionally. So instead you reverse the process, and like you can hear the confidence when I speak. Somebody Irvine asks, "Hey, something about selling gold." I'm like, "Selling gold? Okay. Why the hell would you sell gold?" And it's because I've done this analysis and I've made a decision and I have a bias. And I say, I buy gold. I like gold coming down. I I don't care if it's fallen for 3 days because I'm going to buy a reversal at support. But if it makes a lower low, I wait. I walk away. If it makes a lower low on a 1 hour, I say not today. If it makes a lower low on a 4 hour, I'm like, ooh, something might have changed, but I never bought it, right? Because it's been falling. So when it comes down and finds support and reverses without making a lower low, my confirmation bias kicks in. And I look at that chart with confidence and I'm like, that's me. That's my ride. We're heading north. I'll see you in March. Arrivederci. And I ride that gold wave. And what I'm doing is I'm increasing my internal conviction to actually do it. Kiwi dollar had a monster month, but so did Bitcoin. So for 3 weeks, I'm like, you should probably trade Bitcoin. You should probably, right? You should probably look at crypto. I did the same thing with metals, right? Metals are moving. Maybe you should buy gold. I'm a bull on gold. But also over the last 3 weeks, I'm like, hey, but gold's expensive. Why don't you try silver? We looked at correlation coefficient with silver. It's highly correlated with gold because of the pricing of silver. It's much, much cheaper per trade. And I did all these speeches. You should do that. And then I did speeches around, well, Wayne, I don't like it, or Wayne, I don't trade it, and I'm like, well, why not? Remember all those speeches? Why not? Aren't you looking for opportunities? Hey, you're sick of eating rabbits. Yeah, I get it. But if you can't catch rabbits, you better eat some rats. Remember all that discussion? I have these gruesome imagery, right? And analogies because I'm trying for you to remember. It's an anchoring strategy. So I want you to think, well, uh, I don't trade silver, but I'm hungry. And the best forex trades this month are plus 2.5, minus 2.5, and silver's up 18%. So you got to do what you got to do, right? So I advised you to trade silver 2 or 3 weeks ago. And not just once, multiple times. And I told all these stories. Eat the rat. You're hungry. Your kids need to eat. And then remember, I said, oh, but eating rabbits are better. You like to club cute little fuzzy bunnies with long ears and little cottontails. And I mean, dude, if you're going to eat the rabbit, you got to kill the rabbit. You're okay with that? Hey, put it in your stew. You can't tell the difference between a cute rabbit and an ugly rat. You got to eat. Your kids are got to eat. Okay. You got to eat. Survival. Asset selection. You remember how many times did I do the asset selection speech? The number one thing. What's the right thing? That's for you to figure out. The one asset you're going to focus on first. That's the number one thing. Right? So all these speeches with the hope that you change your behavior. Try something new. So I said, do silver, it's cheaper. And then use micro lots. Just try it. Try it on a demo account. But break your habitual behavior. I like euro dollar. Okay, well, that wasn't bad this month. Good for you. Was that luck? Unless you did quantitative research to say this was the thing you should be trading right now. But I have a feeling you got lucky on this, and Besant made your trade work. Your dumb euro dollar trade worked out. Well, hell's bells. Bless your heart. Is it going to work next year? Is it going to work next month? Is it going to work next week? I don't know. Are you going to buy Scott Besant a Christmas card? Thanks, buddy. Yeah, I don't know. Maybe you got lucky. Okay. So it all depends. What you want to do is be able to look at every asset. Okay. We have almost 80 assets that we're tracking in real time on multiple time frames, quantitatively and technically. So we use, charts are considered quantitative, but we're also looking at macroeconomics, which is quantitative, just different quantitative analysis of different things. And we're doing it in real time, multiple time frames to each other, but also independent. So, we do all this crazy level of analysis. And you should say, well, I'm going to start with Kiwi dollar. And then I'm going to look at Aussie dollar. I might sell USD yen. I might sell USD Swiss franc. Cool. So guess what? This is what we talked about yesterday afternoon. Perma bear on the US dollar. Influenced by the US Treasury. Psychological change of economies around the world. I gave an example of Samsung loves America. They make tons of money in America. But at the end of the year, maybe now they say, oh, all that money in our American Samsung account, we're going to move to our South Korean Samsung account. We'll hold it there in South Korean won instead of US dollars. Well, if that happens, the dollar will weaken. So there's a lot, right? And all of a sudden, so we, yeah. So now we go to this.
US dollar, Fed repricing risk weighs on USD, BBH.
So now we look at today, right now. Where's those dollar trades? I don't see them. It's not weak at the moment. Nor is it strong at the moment. Shouldn't be trading Euro USD. Oh, but it's my favorite. What? But look at your silver. You're crushing it on silver. Having a great morning. You're already bullish. Well, technically, you're bullish on gold. You looked at the correlation coefficient and the cost structure of trading those two assets, and you're like, pretty much the same trade, just 90% cheaper. I'm going to go silver. Sweet. Good for you. How long does silver rally? Forever. Okay. Imagine all you did was trade metals. Now you know when to take your vacation. March and April. Head south, young man. It's cold up north, but if you're going to take your vacation in March and April, yeah, go to the equator. Have a nice, sunny, warm vacation. Get those big drinks in cool shaped hurricane type glasses with little umbrellas on there. Have some rum, some coconut, some pineapple in there. Meanwhile, those metal markets are coming down, but you're already out. You already knew to take profit and go on vacay. So now you plan your whole year around seasonality. Yeah. So look at our opportunities. Oh. Pound is weakening. Look at that creeping in. Creeping in. Pound is weakening as we're watching. Yen is also weak as we're watching. So these are the things you should probably be looking at right this second on your charts. So silver, Bitcoin. Now, Bitcoin is highly correlated to a lot of others. So maybe that's your curve. I don't know. But you're looking at pound weakening. You're looking at yen weakening. Here you are. How does this fit into your longer term plans? You should already know. Yeah, I love selling yen. It's one of my favorite things. I hate buying yen. I hate it. I love selling yen. So how do I respond to situations like this? Well, I have an incredibly set and clear bias. I'm incredibly biased. Even when the central bank makes the Japanese yen the strongest currency in the world. I'm like, I'm gonna, I'm gonna fight against the central bank. That's a heck of a bias. That's a strong conviction, right? Or at least strong opinion, right? So cool. So when I see stuff like this, when I go to the charts, I'm like, oh yeah. And it helps me, my confirmation bias helps me see bearish reversals. So something that was producing red candles has been bouncing at support that I can recognize. I drop into a smaller time frame. Do I have the ability to see a higher high, higher low? Yeah, I'm pretty sure I do. And do I have the strength to pull the trigger? Well, it's such a pissy little trade. Yeah, not a problem. In fact, I can't wait to see the other yen pairs turn bullish, and I have money to put on those. I'm going to bet on all the horses. One of them's going to come across the line first. One of them's going to come across the line last, but they're all going to cross the line. So the way to contrast that in Forex, and in particular the speech today, I could bet Aussie yen goes up. So I can put my whole trade there. What if it collapses? Yeah, that's possible, right? So what if instead of one lot, I do 5 trades today on the yens, 0.2 lots each? What's my risk profile? The same. But I make one trade at a time. 5 independent trades. So I start with Aussie yen. It comes down. It's support. I'm a bull. So I wait, and then double bottoms, and great. Then it makes a higher high. Fantastic. I'm going to buy a higher low. Makes a higher low. I take the trade, and off we go, right? I put a stop. And then I go look at the other trades. I look at CAD yen, I look at pound yen, I look at euro yen, I look at USD yen maybe. I look at all the other yens. What if they don't set up bullishly? Only the Aussie yen. I don't get a trade set up. Now, if I get unlucky because Aussie yen is a one-off, it was noise, I have 80% less risk than I otherwise would have. That's smart. And if the other ones wake up, and all of a sudden I see, so it looks like pound yen wouldn't work today. Maybe euro yen works today. I don't know. I'm not that confident in euro, but what if it does? Well, after a series of red candles, I see it's at tomorrow's pivot point zone, or it's at a roll reversal, or it's on a 4-hour 21 EMA, and then I drop into a 5-minute, and it suddenly is making higher highs and higher lows. I take that shot. But I waited and I waited and I waited and I waited and I waited. Got my confirmation. Hot to go, HOTTOGO. But I still have 60% less risk than I otherwise would have had betting the whole thing on Aussie yen.
Euro trims intraday losses as traders weigh Fed ECB interest rate outlooks.
Okay. No luck. No luck in what we do. We're profiteers. We're financial engineers. And every trade you make has an edge. Fundamentally first, which is strategy, and tactical brilliance on the battlefield. Lowering risk, increasing opportunity, with the goal of you will probably make money. That's a decent goal because you know or can see or can analyze probabilities. No luck. You're like, well, what if I buy a really good trade and then it collapses because there's some sort of news? Yeah, well, that's why you make 1,000 trades a year because that kind of stuff just doesn't happen. So if 0.01% of your losses are from bad luck, that's statistically irrelevant. It doesn't statistically exist. It's an outlier, doesn't even matter. If you only make 200 trades a year versus 1,000 versus 10,000. Okay. 5 trades a day is right. That's
Fed's Goolsby
100
warns political interference with Fed could
that's
fuel
100, right?
inflation.
100 trades a day. So that's 1,000 trades a year, a little more than 1,000. Yeah. You should be able to do that. Yeah. Yeah. And you're like, wait, I'm only doing 2 a day. Well, statistically, you're going to have more volatility. And volatility is bad. Your standard deviation is going to be massive. It's going to be huge. Well, you get lucky. You got a lot of them lucky to the upside, you're going to have a good year. But if next year you're unlucky, you're going to have a bad year. Like, whoa. Can't have that. So again, make good trades, make strategic trades, right? First of all, make strategic quantitative decisions. Then open your charts and have tactical excellence with your technical analysis. The other thing you should do, drop your leverage, drop your lot size, increase your stops so that every trade to you is irrelevant as an individual trade. It's a good trade, but it ain't going to make you filthy, stinking rich. Making 1,000 good trades will make you filthy, stinking rich. Yeah. And then you'll want to make 10 trades a day as your account size grows. Because if you did that, again, keeping your lot size lower, what happens? You're removing luck. You're making 2,400 beautiful trades a year. There's no way you're going to be unlucky, statistically speaking. Why did you buy gold? Well, I did research and, well, it shows that it was going to go up for 9 months. So I bought at 4,000 and now we're at 6,000. Nice. Okay. So anyways, you could have bought at 4,000. We're trying to get to 5 by the end of the year. So what about in March? When you take profit and go on vacation?
Fed's Schmid warns energy shock is leaking into the economy.
Cool, right? Well, that's how you should do it for yourself. And try being in those trades longer, because if you knew gold has the potential for going up every month for the next 9 months, why would you day trade it? You're like, well, Wayne, I'll day trade it every day. Oh, 1 trade a day? What about 1 trade a day, let the winners run? So in March, okay, you have 180 trades long gold, each one taken individually, each one with tiny, tiny, tiny levels of risk. And before you entered another trade, that risk is removed. And then you enter another one. And then you enter another one. So what do you think? 180 individual trades or a position in gold of accumulation of 180 individual trades? Which one's going to make more money? Yeah. Now, the what would you call it? Your portfolio position type trade has different levels of risk, and you'll get used to that. But that's the only difference now is risk management and opportunity cost versus having piss poor risk management and not opportunity cost, the loss of cash. There's a big difference. Like, think of it this way: 180 trades, every stop is at break even. You can't lose money. Well, what if there's a 10% drop in gold and it takes out of your 180 trades, it takes out 40 of your trades? Yeah, you didn't lose money. You lose the opportunity to cash out with profit. Maybe you should have seen that coming, but maybe it was just bad luck. Happens. But I think if you analyze it versus the day trading, you're way better off. At least knowing that there's other ways to trade, and you should explore those. I love scalping. I love day trading. I love swing trading. I love position trading. Yeah. Yeah. Denise has been in a trade for 21 days. Yeah.
U.S. jobless
To put it in
claims
perspective,
unexpectedly dipped to 203,000.
I bought Apple for $6 a share and held it for 30 years. Let that winner run. Crikey, she's a beaut. Yeah. So it's all fair game, right? The thing is to understand the different opportunities and try it. Yeah. Nobody said it was easy, but if you can do it well, the rewards, I think, are greater, including less risk. Less risk is a reward. What gets people wrong is they try it at the wrong time of year, right? So with gold, what was it? March and April, gold is down, and then it rallies back up or whatever it is. So imagine on the red month, you start trying to let you sell gold because it's a down month and it's been falling for 6 weeks straight. So now you start selling gold and holding it short. And you've forgotten that, well, in the next 3 or 4 weeks, there's an extreme high probability that gold goes up and never stops going up. And you're practicing letting your winners run to the short side. And then you get frustrated because it comes back and knocks you out. You're like, this thing's stupid. No. You should have been waiting to buy gold because it's been falling. And then knowing that the next month, all have high probabilities of up. So that you want to kind of start the accumulation process near the beginning, right? So that you have more likelihood of having it run. And so, but every year is different. But since we have 20 years of data, broken down into 10 years of data, broken down into 5 years of data, we have standard deviation and averages to help understand all of this. You're betting on normal processes. Not randomness. Therefore, I propose that that's engineering. You're using the data to formulate the most optimal most likely results based on real data. Cool. So that's good. So Denise, if you're in trades that have that
European Central
future
Bank, September hike,
potential,
prospects strengthen, Nordea.
that's great, right? And see how far it goes. But also, since it is the third week of August, don't be shocked if they all come back and knock you out at zero, right? That happens because 3 weeks, this is the training here. 3 weeks is nothing. It's a good start, right? But is 3 weeks 3 months? No. Like holding for a whole quarter is terrifying, right? Yeah. No, but it is. Like I'm not making light of it, but we do it at the Council of Investment Advisors. And somehow we're able to buy the S&P 500 and be long for 2 years. We're cool with that. Right? Why not be long Aussie dollar for 2 years? What's the difference? Perspective, bias, right? For some reason, we view one differently than the other. Well, maybe that isn't always good, right? So this is why I teach investing as well as trading. Wouldn't it be something if you analyze things for the best you possibly could and then made a trade on your MT5 you intend to hold as long as possible, like literally never get out of it? You have a stop at break even. What's the big deal? What's the challenge? How would you feel 5 years from now if you logged in and that trade is still sitting there and you're like, son of a biatch? That is just so funny, right? You're like, it's just sitting there. But you'll also then see there are periods of 6 weeks of not going in the long-term direction. How do you feel? Well, now but you're looking at it from a different point of view, and you're like, well, this usually underperforms in the first quarter, but in the second quarter recovery, third quarter expansion, fourth quarter profit taking. So you're like, okay, so it's going to have that pullback in the first quarter. Got it. It's coming down. Like I showed you in gold. Gold came down exactly when it's supposed to come down. All right, so it came down. Great, good, good, good. Then what? Maybe I'll add another pissy little trade that I have no stress over. Manage that for 3 days, move the stop to break even, and then see you next year. See you in December, right? Who knows? You might find that that's the best way to trade. Huh? You have to force yourself once a week to look at your positions. You're thinking quarterly as a strategy in the context of annual moves. Yeah. Do you know what's really cool about fractal geometry? Is you analyzing your daily and your weekly chart is the same as you analyzing, let's say, your 15-minute chart relative to your hour or 4-hour chart. There's no difference. So you might be pretty kick ass on a smaller time frame, guys. You're pretty capable, but there's a lot of bad luck in your trading on your 5-minute, your 15-minute, your hourly. And sometimes you make money, but 3 days later you give it all back and it's working, then it's not working. And you make a trade, then it fizzles out and all that kind of stuff. But you're still technically proficient. You're just not at the results you were expecting. What if, and you'll never know unless you test and analyze, but what if you're very, very, very capable technically? And I think most of you are technically proficient. But what if you applied the same rules of engagement on, let's say, 4 hours for scalping and daily and weekly for analytics? What if you found your technical proficiency works just as great on those bigger time frames, but now to hit your target, you need 4 months, 5 months, 6 months? It's so painfully slow versus your 5-minute chart. Well, if you want some excitement, play Fortnite, not Forex. Okay? Yeah. Number one thing here is you have to change your behavior. And the next thing is you have to control your interpretation, your vision, your bias. If you don't know what you're going to do, and 90% of everything you see is made up, then when you go to your charts, you're going to be random. So now, if you change your behavior and do the research and have a very clear bias and intent backed up by actual data, and you drop your lot size, increase your stop size, move those to break even so you can make more trades, each trade independently risky. So imagine, again, 10 trades a day, 1 micro lot versus 1 mini lot. But you can't add another micro lot trade until the first one has been moved to break even. Then your risk now is always 90% less, even if over the day you made 10 trades. Okay. Because you make 1 trade right now, boom, 100% risk. But if you make 1 trade now at 90% risk, and then an hour later, another one 90% less risk, and then an hour later, another one 90% less risk, you're always 90% less risk than that 1 trade. And you're less terrified every time you pull the trigger. My God. If you only have the strength to get out of bed and try it, it might radically and revolutionize everything that you do. And what you see and how you feel is all dictated by this. It just might work. Peace on earth. May the pips be with you. May your profits be above average. TTFN, ta-ta for now. And for those that have leveled up, I will see you at 4 o'clock for our afternoon webinar. Cheers.